Today, we're jumping into a really fascinating investment strategy. And what's cool about it is that it's not about trying to predict the future. Nope, it's about reacting to things we already know are going to happen. We're looking at a 10-year analysis of a system built to take advantage of the regular, scheduled changes in India's Nifty 50 index. So that leads us to the big question, right? Can you actually build a profitable strategy around events that are already on the calendar? The whole idea here is pretty simple. When these giant institutional funds are forced to buy certain stocks, it creates this big wave, a wave that a smart investor might just be able to ride.
All right, so let's get into it. Where does this opportunity actually come from? What is this predictable event that gets the whole thing started?
Well, it all boils down to one thing, the Nifty 50 rebalancing. Twice a year, the list of companies in India's main stock market index gets a refresh. Some companies might get kicked out, and new ones get invited in. Now, here's the kicker. When a new stock is added, every single fund that tracks the Nifty 50 has to buy it. They have no choice. And that creates a huge, predictable surge in demand. That's the wave we're talking about. And this doesn't just happen randomly. It happens like clockwork. There's a review in March, and then another one in September, year in, year out. On average, you see about 2 to 3 new companies joining the Nifty 50 each year. It's this consistency that makes a systematic approach even possible. Okay, so we know why this happens and when it happens. So the next logical question is, how would you actually trade it? Well, the strategy itself is a super disciplined 6-month plan. The mechanics here are surprisingly simple. Step 1, you figure out which new stocks are coming in. Easy enough. Step 2, you invest your money equally across all of them. You don't play favorites. This diversification is absolutely key. Step 3 is probably the hardest part. You just hold on for exactly 6 months. No getting spooked by a bad week, no trying to sell at the perfect peak, just hold. And finally, step 4, after those 6 months are up, you sell everything and you roll all that money into the next group of new stocks. It's all about that rinse and repeat compounding. Okay, so it sounds simple, right? But now we get to the most important question of all. Does it actually make money? And just as important, what are the risks? Let's dive into the numbers. So, what could this look like over the long haul? Well, based on a 10-year historical backtest, that compounding effect is pretty powerful. A starting investment of 1 lakh rupees could have grown to about 2.30 lakh. So yeah, you're more than doubling your money with a simple, repeatable system. But that juicy number isn't the whole story. Because here's the reality check. This is not a guaranteed win every single time, not even close. When you look at how these stocks do in their first 6 months, yeah, about 60% of them give you a positive return. But that means a full 40% of the time, the stock actually loses ground. And this is exactly why you have to invest in all of the new stocks, not just pick one. And this really gets to the heart of the trade-off. On one hand, you've got this awesome potential upside. The winning stocks tend to do really well, giving you returns anywhere from 4 to almost 10% in just 6 months. But on the other hand, you're constantly fighting against these drags, things like momentum traps and transaction costs that are always trying to eat away at your profits. Let's break those risks down a bit. The momentum trap is a big one. You have to ask yourself, by the time this is public news, has the stock already shot up? Are you just buying at the top? Then there are transaction costs. Brokerage fees, taxes, they seem small, but since you're trading every 6 months, they can chip away 1 or 2% from your returns every single year. And when you add in that 40% chance of a stock underperforming and the risk that the price moves against you before you can even buy, well, you can see how these things can really add up. So when you put it all together, the potential gains and all the pitfalls, what's the final verdict? How does this active strategy really compare to just, buying a simple index fund and calling it a day? And here's where it all comes together. The analysis suggests this strategy could give you annualized returns somewhere in the 9 to 11% range, which sounds pretty good. But a basic boring Nifty 50 index fund has averaged around 11.8% over the same kind of period. So what does that tell us? It tells us the strategy is competitive, for sure, but it doesn't necessarily blow passive investing out of the water. It's just a different way to play the game. So if you were going to try something like this, what's the secret sauce for making it work? Well, it all comes down to a few things that are totally non-negotiable. You need ironclad discipline to stick to that 6-month rule. You absolutely have to diversify to handle that 40% chance of picking a loser. And you've got to keep a close eye on those transaction costs to make sure they're not quietly draining your profits. And that really is the bottom line here. As the analytics team that ran the numbers put it, This whole thing requires disciplined execution and regular evaluation. This is not a set it and forget it kind of plan. You have to be on top of it. Which brings us to our final question, and this one's really for you to think about. Knowing that this whole strategy depends more on rigid discipline than on making clever stock picks, and knowing that it offers a solid return, but maybe not a better one than just buying the index, is this disciplined opportunity actually right for you and your investment style?